auditors liabilities, and we are done with criminal. We create criminal. Excellent. Now we look at number 2, civil under the law of contract. 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 So we usually say that auditors enter into contract with the client. Auditors enter into contract with the client. And this contract is entered into when engagement letter is drafted. It's a number 210. Engagement letter is the contractual map. It is the contractual map between the auditor and the client. So we need to follow the guidelines in the engagement letter amongst other professional pronouncements. The auditor is considered to have breached contract when he is negligent. So when the auditor is negligent, then he has breached the contract because it means he is not doing what a reasonable person should do, or he is doing what a reasonable person, a professional accountant, should not do. We'll discuss a case. Yes, Random Storage Company, Random Oil Storage Company. What was happening here? The auditor was verifying petty cash. Yes, the auditor was verifying petty cash, and relying on the records, there was £786 as per the records. As per the records, he never bothered to confirm. He concurred with the petty cashier that this is the petty cash which was in the cash till, only to be realized later that there was only £30 in the cash till. All the other amounts had been embezzled. All the other amounts had been embezzled, but the auditor did not detect because he never verified. Yes, he was seen to be negligent, and the client successfully sought legal redress in the corridors of justice. He was negligent in this sense. Cash is a very sensitive item and assets, very sensitive item and assets. Actually, cash, we can never talk of sampling. Yes, it's a number 530. We can never talk of sampling. Cash, you count everything. You count everything. He never even insisted on confirming how much was in the cash till. Now, there are some aspects which the client must be able to indicate for them to be successful in this civil under the law of contract. The client must be able to indicate, number 1, that there was a contract between him and the auditor. Number 2, that the auditor breached the contract. Number 3, that he suffered loss. Number 4, the loss is quantifiable into monetary terms. And number 5, that the loss suffered is as a result of the direct negligence on the part of the auditor. That there was a contract, there was breach, suffered loss, loss is quantifiable into monetary terms, and the loss can be directly attributed to the negligent or to negligence on the part of the auditor. Let's summarize that. The auditor has a contractual relationship. The auditor has a contractual relationship with the client. Auditor has a contractual relationship with the client, and therefore, any breach of contract, will expose the auditor. Any breach of contract will expose the auditor to civil liability. Any breach of contract will expose the auditor to civil liability under the law of contract. Any breach of contract will expose the auditor to civil liability under the law of contract, under the law of contract, full stop. Another paragraph say, for the client to succeed in this case, for the client to succeed in this case, for the client to succeed in this case, then they must prove, for the client to succeed in this case, then they must prove, for the client to succeed in this case, then they must prove, Roman number one, Roman number one, Roman number one, there was a contractual relationship. There was a contractual relationship. There was a contractual relationship between the auditor and the client. There was a contractual relationship between the auditor and the client. There was a contractual relationship between the auditor and the client. Roman number two, the auditor was negligent. The auditor was negligent in carrying out his work. The auditor was negligent in carrying out his work. The auditor was negligent in carrying out his work. In carrying out his work, i.e., there was breach. There was breach on the terms of the contract. There was breach on the terms of the contract. There was breach on the terms of the contract. There was breach on the terms of the contract. Number three, out of such negligence, stroke breach of contract, out of such negligence, stroke breach of contract, stroke breach of contract, the client suffered loss. The client suffered loss. The client suffered loss. The client suffered loss. Next point, the loss is quantifiable. The loss is quantifiable into monetary terms. The loss is quantifiable into monetary terms. The loss is quantifiable into monetary terms. Quantifiable into monetary terms. Next, the auditor's negligence. The auditor's negligence. The auditor's negligence is the direct cause of the loss. The auditor's negligence is the direct cause of the loss. Auditor's negligence is the direct cause of the loss. Excellent. Skip a line and have Rwandan Oil Storage Company, Rwandan Oil Storage Company, 1904. Rwandan Oil Storage Company, 1904. Rwandan Oil Storage Company, 1904. 1904. 1904. I didn't say the petty cash was misappropriated. The petty cash was misappropriated. The petty cash was misappropriated over a period of years. Petty cash was misappropriated over a period of years, such that the balance as per the petty cash records, the balance as per the petty cash records, balance as per the petty cash records was 786 pounds, was 786 pounds, was 786 pounds, was 786 pounds, while in the cash box, the amount was 30 pounds, while in the cash box, the amount was 30 pounds, while in the cash box, the amount was 30 pounds. The amount was 30 pounds, full stop. The auditor did not count the cash. The auditor did not count the cash. The auditor did not count the cash. The auditor did not count the cash, and therefore did not discover, the embezzlement, and therefore did not discover the embezzlement, therefore did not discover the embezzlement, did not discover the embezzlement, full stop. Another paragraph on the same say, it was held that the auditor had been negligent. It was held that the auditor had been negligent. The auditor had been negligent for not counting the cash. The auditor had been negligent for not counting the cash, as he would have been put upon inquiry. I take it again. It was held that the auditor had been negligent for not counting the cash, as he would have been put upon, as he would have been put upon inquiry. He would have been put upon inquiry. He would have been put upon inquiry by surprisingly large amounts, of petty cash balance, put upon inquiry by surprisingly large amounts of petty cash balance, That's it on civil under the law of contract. We look at Roman number 3 and the last one, civil under the law of tort, into brackets, third party liability. Third party liability. Third party liability. So what happens in this? Audit has evolved over time. Audit has evolved over time that we can talk about traditional audit and contemporary audit. Yes. In traditional audit number 1, we were performing manual audit. In contemporary, we've computerized, because the clients have also computerized the accounting aspect. Number 2, we were performing vouching audit. In contemporary audit, we perform system-based or risk-based audit. In early audit, auditors were looking for errors, frauds, irregularities. In contemporary audit, it's just about forming an opinion, of course, guided by the terms, truth and fairness. In traditional audit, there was no aspects of stewardship concept and corporate governance. Governance issues, which are very much present in the contemporary audit. Then number 5, auditors were only reporting to the owners of the business. But in contemporary audit, they owe a duty of care to third parties. And this is where we are under the civil liability, under the law of contract. So when we'll be discussing common law cases, We will look at the common law cases which happened then. Yes, like in 1932 and 1929s, yes, where auditors were only reporting to the owners. Nobody else would have claimed a liability. The courts then were arguing that there is no proximate relationship. There is no proximate relationship between the auditor and third parties. And the third parties are not privy to the contract. And if you're not privy to the contract, neither can you have rights in that contract nor obligations attached in that contract. Though currently we have like 5 exceptions to the privy to the contract: issues of trust, issues of agency, issues of audit with regard to that party liability, that party motor vehicle insurance policy. All those are exceptions. Then in the contemporary audit, we look at the cases where a third party successfully sought legal redress upon relying on the auditor's professionalism, and they suffered quantifiable financial loss. The first case that we'll discuss is Aaa versus Niven Touch of 1932. Of course, the arrangement is that of a plaintiff and defendant. These are the auditors. Niven Touch are the auditors. They are defending themselves, where they had certified a balance sheet. They had certified a balance sheet belonging to another company, that it portrayed a true and fair view. Yes, the company prepared a statement of financial position, subjected it to audit. Niven Touch gave a go-ahead, or else they gave a clean bill of health with regard to this balance sheet. Now, the Aaa, who are the financiers, guided by the balance sheet or based on this balance sheet which had been certified, they went ahead to advance the loan to the other company. Later, this balance sheet proved misleading. Yes, that auditors issued a misleading opinion about the balance sheet. It had been exaggerated. It never portrayed true and fair view. So Aaa are seeking legal redress. They are suing the auditors, Niven Touch. They never succeeded. They never succeeded. The House of Lords indicated that there was no proximate relationship between the banker and the auditor. So there is no way that a liability would have accrued. There is no way that a liability would have accrued. That is then, until 1963, in the case of Head Rebellion versus Hera and Partners of 1963, plaintiff, defendant, both of them were bankers. Both of them were bankers. We had a client by the name AC Power. AC Power was banking with Hera and Partners. Yes, AC Power was banking with Hera and Partners, but when they needed some financial support, they approached Head Rebellion. Now, since Head Rebellion did not have information about the creditworthiness or ability to repay of AC Power, Head Rebellion approached Hera and Partners so that they can give letter of reference with regard to creditworthiness of AC Power. Now, Hera and Partners gave that reference letter to Head Rebellion, indicating that AC Power is creditworthy. You can go ahead and grant them the advance. Yes, Head Rebellion, relying on that reference, they advanced loan to AC Power Company. Later, AC Power Company miscarried in their own repayment. They defaulted, and now Head Rebellion are suing Hera and Partners for recklessness, for negligence, yes, in issuance of the letter of reference. The House of Lords indicated that Hera and Partners would have been liable if it were not for the disclaimer clause that they introduced. Yes, what Hera and Partners did, they introduced while giving out the reference, the letter of reference, they introduced a disclaimer indicating that they will not accept any liability if that reference turns out to be untrue. Or else they will not accept any liability in event that AC Power defaults in loan repayment. Now the House of Lords is indicating that Hera and partners would have been squarely held liable for negligence if it were not for the disclaimer statement that they introduced. So later on, when we'll be discussing ways of minimizing auditors' liability, then point number one should be introducing a disclaimer. Yes, introducing a disclaimer is a way of extinguishing auditors' liability. But we have issues. We have issues with the disclaimer statement. Somebody in the past papers? I've left mine. Yes, there's you have the past papers? Yes, there's a question somewhere. I don't know whether you have yes. That's name should know how we invest. Yes, in making sure that we pass. You see how this work is organized? Yes, they should know how much we invest. They stop disturbing us. I'm just checking whether I can be able to trace that question. I can recall it's a question number 5 somewhere. Can't remember the sitting, but again, it will be very easy to trace it because it's question number 5. Yes. Yes, I'm encouraged to ensure my past papers look like this. Yes. All right. Question number 5. It was asking, what would be the implication? What would be the implication if auditors introduce a disclaimer in their report, in their unqualified report? Yes, it has got some, I don't think it's here. What would be the implication if auditors introduced a disclaimer statement in their report? Introduced a disclaimer statement in their report. It's a very sensitive topic because the examiner is saying that the auditor has checked through the records. Can look at it later. The auditor has prepared a report. It's a number 700. Paragraph number 6. The books of accounts portrays true and fair view. Then he is saying, I distance. He is distancing himself or herself from anything that may arise as a result or any losses that may be suffered by third parties out there or anybody out there upon relying on this auditor's report. Can we even call this an audit? It's very, because why audit? Why subject books of accounts to audit? Of course, you want to report whether they portray true and fair view, but we achieve other 3 main objectives. That number 1, audit is able to reduce information risk. Audit is able to enhance the confidence of the intended users. Audit is able to enhance the credibility of the financial statements. See what this auditor is doing. He's giving a clean bill of health, but again, distancing himself from any repercussion that one may have. That's what that question was asking. What's the implication of this disclaimer? The implication is it will affect the quality. It will affect the quality of audit. This is not an audit per se. It's not achieving the objectives which it is intended to. So it was worth 8 marks. It is affecting the quality of the audit. Number 2, it is affecting the quality of the opinion, the quality of the opinion, because it's not a serious opinion as it should be. Yes, it is affecting the quality of the opinion. Number 3, it will even have the charges when it comes to audit fee. Audit fees. Audit fees are likely, in this case, you can't afford to pay millions of cash as audit fee, yet the auditor does not accept any liability. I'm seeing a scenario where the client will begin to pay less amounts. Like we'll have, like the way we buy things from Muhindi, do you want a receipt or you don't want? You remember that conversation? So if it's the receipt, this is the much you're paying. Without a receipt, this is the much you're paying. we are likely to get into that conversation here, that are you introducing a disclaimer? If you're introducing a disclaimer, then this is the much I'm paying. Without a disclaimer, this is a much. And you see, with regard to audit fee, we have ethical guidelines with regard to audit fee. Yes, issues of lowballing, of independence of an audit client, those issues of audit fee. So here, there will be a big problem with regard to audit fee. That's the disclaimer. That's the disclaimer statement. I believe I'll be able to trace that question so that you see how it was supposed to be approached. So we like those cases. Then I'll add you some more guided by another past paper question. Introduce, then later we can ask questions if any. Third parties do not have a contractual relationship. Third parties do not have a contractual relationship with the auditors. Third parties do not have a contractual relationship with the auditors. Do not have a contractual relationship with the auditors. However, they can sue an auditor. However, they can sue an auditor for negligence. They can sue an auditor for negligence or breach of duty of care. They can sue an auditor for negligence or breach of duty of care, or breach of duty of care. Full stop. Another paragraph say, in Aaa auditing, comma, auditors did not have any liabilities arising. Auditors did not have any liabilities arising from the law of tort. Auditors did not have any liabilities arising from the law of tort. That's what you've said. Did not have any liabilities arising from the law of tort. Full stop. This was because they did not have a contractual relationship. This was because they did not have a contractual relationship with the third parties. This was because they did not have a contractual relationship with the third parties. A contractual relationship with the third parties. And therefore, no chance of liability. And therefore, no chance of liability accruing. And therefore, no chance of liability accruing. And therefore, no chance of liability accruing. So this is what used to happen. You sue an auditor and maybe you don't succeed. Now the aggrieved parties were suing the directors. We are going ahead to sue the directors, because we know these are the persons with primary responsibility. Directors have the primary responsibility to institute very strong internal control systems to be able to prevent, detect, and correct errors, frauds, and irregularities. So the argument was it is the directors who have failed in their mandate, yes, to prevent errors, frauds, irregularities. You'll see that in the Caparo Industries versus Dickman and others, Skip around and have. In the case of Ultrameyer, versus Niven-Tauch 1932, in the case of Ultrameyer versus Niven-Tauch 1932, Ultrameyer versus Niven-Tauch 1932, Ultrameyer versus Niven-Tauch 1932, it was held that the auditor has no legal relationship. It was held that the auditor has no legal relationship The auditor has no legal relationship in absence of contractual relationship. The auditor has no legal relationship in absence of contractual relationship. In absence of contractual relationship. In absence of contractual relationship. Full stop. Another paragraph say, in this case, the banker advanced a loan. In this case, the banker advanced a loan. The banker advanced a loan to a rather company, to a rather company, to a rather company, on the strength of a balance sheet, on the strength of a balance sheet, on the strength of a balance sheet signed by the auditors. Strength of a balance sheet signed by the auditors, which in essence was the ground for granting the loan, which in essence was the ground for granting the loan. In essence, was the ground for granting the loan, was the ground for granting the loan. Full stop. Another paragraph. The balance sheet later proved to be fraudulent. The balance sheet later proved to be fraudulent. The balance sheet later proved to be fraudulent and misleading. Later proved to be fraudulent and misleading. Fraudulent and misleading. Full stop. It was decided that there was no chance. It was decided that there was no It was decided that there was no chance of any liability arising. There was no chance of any liability arising, as there had no contractual relationship. As there had no contractual relationship between the auditors and the bankers. No contractual relationship between the auditors and the bankers, between the auditors and the bankers. So that is Aaa audit. That is Aaa audit. The auditors were only answerable to the owners, and no third party would successfully sue the auditor. Let's have another case. Lee Kingston Cotton Mill. Lee Kingston Cotton Mill Company Limited of 1896. Lee Kingston Cotton Mill Company Limited of 1896. Of 1896. Of 1896. In this case, the account had been falsified. The account had been falsified. The account had been falsified to a very considerable extent. In this case, the accounts had been falsified to a very considerable extent by the managing director by extensive overvaluations of stock, by extensive overvaluations of stock. By extensive overvaluations of stock. By extensive overvaluations of stock. Stock is a very sensitive commodity when you're auditing. Yes, it's very sensitive. We have a stock account. We have a stock account here. What do we debit? What do we credit in this stock account? We debit purchases. We credit sales. It's owner and family. What are we debiting? What are we crediting in the stock account? Debit. Debit returns inwards. Credit returns outwards. Do you have a person with contrary opinion? Ama ni mimi peke yangu tu niko na contrary opinion? Yes? We don't have a stock account. We don't have a stock account. Purchases are posted in purchases account on the debit side. Sales credited in the sales account on the credit side. Returns inwards debited in the returns inwards account, returns outwards credited in the returns outwards account. We don't have a stock account. And now you know, and that's what makes it very difficult to audit stock. It's not easy to audit stock. There are things which are very technical. Stocks and provisions, stocks and provisions, because they're just estimates. Stocks, we determine the value of stock guided by IAS number 2. We have several ways of determining the closing stock: FIFO, LIFO, or weighted average. I don't know whether you've ever tried using them and you're getting different results for the same stock. Yes, even in classwork. You'll get different results for the same stock. So you can imagine now what you'll record, what an accounts person will record. Plus, it's determined by way of physical verification. Yes, physical verification, quantifying it, of course, guided by the lower of stock, the lower of cost and the net realizable value. So we agree there's confusion about the valuation of stock, but it does not take so long before we can ascertain the true value. This is one of the instances where we talk of the balance sheet events. Of the balance sheet events, we are guided by ISA number 560, 560 stroke IAS number 10, subsequent events. What happens is, after the end of the year, we have the closing stock. Then after like 3 months, we can now tell whether this closing stock was properly valued because we have realized. Most likely, between the first 2 months, this closing stock will be sold. So we can always compare the realized amount . This one. All right. So we are told that by extensive overvaluations of stock, we've gotten right about those aspects, how stock is valued, and how we can always tell whether it was overstated or. Let's proceed. Full stop. In this instance, the auditors were deceived. In this instance, the auditors were deceived. The auditors were deceived, and although they acted with due care, they had understandably missed the deception. 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 Sometimes you employ all the due diligence. Yes? You employ the due diligence, and especially when you want to buy an item, piece of land, you check with the RADs to confirm it's the piece of land is in existence. It is not a riparian land. It's not a road reserve. It does not belong to the government. But later along to your supplies, you realize you were defrauded. So sometimes, as an auditor, you ensure that you're not negligent at all. You carry out all the necessary and expected audit procedures, but still some deceptions may pass, or some misstatements may pass unnoticed. Full stop. Another paragraph. Lord Justice Ridley, L-I-N-D-L-E-Y. Lord Justice Ridley stated that the auditor is not bound to be a detective. Lord Justice Ridley stated that the auditor is not bound to be a detective. The auditor is not bound to be a detective, comma, he is a watchdog. He is a watchdog. He is a watchdog. Full stop. In this instance, the directors are liable. In this instance, the directors are liable to the shareholders. In this instance, the directors are liable to the shareholders for fraud. Directors are liable to the shareholders for fraud. Liable to shareholders for fraud. That's what I was explaining, that it's directors who will be held liable, or was being held liable in this area audit, because it's them who have got the primary responsibility to prevent, detect, and correct errors, frauds, irregularities. Plus, of course, we said that ISA 240 is clear and categorical. ISA 240 is clear and categorical that auditors do not have any responsibility with regard to errors, frauds, irregularities. Although we said that auditors should endeavor to plan their audit in a way that they can be able to detect any material misstatements. They should endeavor to plan their audit in a way that they can be able to detect any material mistake. So it's all about striking a balance. You see that when the auditors were absolved because that misstatement passed them, but they had done everything possible, but they were not able to detect it. They were not able to detect it. Excellent. I told you today we'll do several cases. Caparo Industries. I'm guided by a question paper here. I'll check which one. So it's a part paper question that I'm answering. Caparo Industries. Caparo Industries. Online students, yes, you're able to see. Caparo Industries Public Limited Company versus Dickman and others. Dickman and others of 1990. Sio kitambo sana. Yes, of 1990. Of 1990. Of 1990. There's somebody who had asked this question about takeover last class. I can't remember who had asked. Who had asked? Is she in today? No, she's not in, eh? Yes, and we discussed how takeover can be. Do we have Kenyan common case? Do we have Kenyan judicial precedents which we can find in notes indicating how some cases were determined? Have you ever come across some? Oh, the most recent one. That one I'm not party to it. Yes. They said that people will be going with what they have bought, even if it's in matrimony. It's not 50-50. Is it fair? Yes, it is. I didn't see it being fair because, you know, sometimes you may agree, you'd be taking care of school fees and rent, then I'll be taking care of household items. Then we're parting ways. Now, where will I go for my fees and my rent for those children? Yes, when they grow up. Yeah, that one is very tight. That one is very tight. Although that one, it was not in favor of whoever, because it may happen to either the boy child or the girl child. Yes, there's one of Wambuyo Otieno. If you read the textbook done by Saremi on business law, although it is with regard to succession, with her late husband, the Otieno, there were some legal tussle on management of the deceased person's estate. It is in the books. You know the Wambuyo Otieno, right? Yes? You don't? You don't? Well, okay. So, as Wambuyo Otieno was a politician, a renowned politician, He was married to a Luo man. The other day, let me call it the other day, he married a younger boy known as Bogwa in Naivasha. And Bogwa's mother was in shock and she passed on. She died immediately after Bogwa married the Wambuyo Otieno. Yes. But this case came before that marriage of Boy and Bogwa, about the tussle of, you can check, I'm not sure whether it's in Google, but in that textbook, I'm pretty sure about it. I'll check and see how, because sometimes students ask, why are we studying cases which took a long time ago, which happened in 1904, 1886? Why foreign cases? Don't we have local judicial precedents which we can learn on how they were determined? Yes, we have the Wambuyo Otieno case. All right, Kaparo Industries PLC versus Dickman and others of 1990. Say in 1984, Kaparo Industries acquired a company. Kaparo Industries acquired a company. Kaparo Industries acquired a company called Fidelity. Kaparo Industries acquired a company called Fidelity on the basis that the company profits were in excess, on the basis that the company profits were in excess, on the basis that the company profits were in excess of £1 million, of £1 million, in excess of £1 million, in excess of £1 million. That is in 1984. After the takeover, Kaparo claimed Caparo claimed that the auditors, touch loss, touch, T-O-U-C-H-E with an apostrophe, touch loss, R-O-S-S. Touch loss, R-O-S-S. So Caparo claimed that the auditors touch loss owed a duty of care to investors. Yes, Caparo claimed that the auditors touch loss owed a duty of care to investors and sued them. Touch loss owed a duty of care to investors and sued them. Caparo has sued touch loss. The reason why we are seeing Dickman and others, these are the directors, because the courts ruled that touch loss, where the auditors did not owe a duty of care to strangers, any people out there. So that is in Aaa Audit. Full stop. They claimed touch loss should have seen, touch loss should have seen the vulnerability, of the company, should have seen the vulnerability of the company, and therefore foreseen the likelihood of a takeover, full stop. However, the law lords, Sharia, the law lords, as the judges, the magistrates. However, the law lords, L-O-R-D-S, the law lords were unanimous. The law lords were unanimous. The law lords were unanimous that auditors do not have. A duty of care. Unanimous that auditors do not have a duty of care to individual shareholders, or future investors. Do not have a duty of care to individual shareholders or future investors. They were unanimous. Full stop. They also came to the conclusion that some previous cases had been wrongly decided. We'll read like the head rebellion case, because this one is indicating that the auditors were a duty of care. So they're arguing that it was wrongly decided. Full stop. This is 1990. Full stop. However, Caparo went on to successfully pursue their action. Caparo went on to successfully pursue their action for damages. Against the directors. However, Caparo went on to successfully pursue their action for damages against the directors of Fidelity, against the directors of Fidelity, namely the Dickman brothers, namely the Dickman brothers, namely the Dickman brothers, namely the Dickman brothers. That's enough. That's enough. Now let's see what was about the head rebellion, about the contemporary situation in audit, the contemporary situation in audit. Skip a line and say, in head rebellion, I need to write it afresh, that our online family and ourselves can be able to get it right. In head rebellion versus Hera and Partners of 1963, in head rebellion versus Hera and Partners of 1963, head rebellion versus Hera and Partners of 1963, the House of Lords, the House of Lords decided that the House of Lords decided that the Ultra-Myers case decided that the Ultra-Myers case was wrongly decided. House of Lords decided that the Ultra-Myers case was wrongly decided. The Ultra-Myers case was wrongly decided, and that professional negligence can arise. Professional negligence can arise if a financial loss. Professional negligence can arise if a financial loss is suffered by third parties. If a financial loss is suffered by third parties, financial loss is suffered by third parties who rely on professional skills, and judgments of persons with whom they have no contractual relationships. Rely on professional skills and judgments of persons with whom they have no contractual relationships. Judgments of persons with whom they have no contractual relationships. Full stop. Another paragraph. In this case, before entering into the transaction, with AC Power Company, the plaintiff sought reference. The plaintiff sought, S-O-U-G-H-T. The plaintiff sought reference. The plaintiff sought reference of the company's financial position. The plaintiff sought reference of the company's financial position. Sought reference of the company's financial position from the bankers. From the bankers. Sought reference of the company's financial position from the bankers, into brackets, defendants. into brackets defendants, because both parties were bankers. So we are referring to the defendants. Defendants, full stop. The bankers gave reference. The bankers gave reference. The bankers gave reference. The bankers gave reference, but stated that they accepted no liability. Stated that they accepted no liability. They accepted no liability, stroke responsibility. Accepted no liability, stroke responsibility for accuracy of that reference, but stated that they accepted no liability, stroke responsibility for accuracy of that reference, for accuracy of that reference, for accuracy of that reference. Full stop. Another paragraph. The reference later proved misleading. The reference later proved misleading. The reference later proved misleading, later proved misleading, later proved misleading. And the bankers were found, and the bankers were found, and the bankers were found to be negligent. And the bankers were found to be negligent. And the bankers were found to be negligent. Full stop. In the ruling, the House of Lords held that, in the ruling, the House of Lords held that, the House of Lords held that the bankers had been negligent. In the ruling, the House of Lords held that the bankers had been negligent. The bankers had been negligent, but the disclaimer, so we are saying in the ruling, the House of Lords held that the bankers had been negligent, but the disclaimer protected them, and therefore they could not be held liable. And therefore they could not be held liable. And therefore they could not be held liable. Therefore they could not be held liable. They could not be held liable. Last weekend, I left you with a case of Donoghue versus Stevenson. Skip a line and have Donoghue versus Stevenson of 1932. Donoghue versus Stevenson of 1932. You remember this case? Donoghue versus Stevenson of 1932. Write and say, this case established that, this case established that, this case established that a duty of care is owed. This case established that a duty of care is owed to parties outside. The duty of care is owed to parties outside a contractual relationship. This case established that a duty of care is owed to parties outside a contractual relationship, to parties outside a contractual relationship. Full stop. This case refers to the sale. This case refers to the sale of goods. This case refers to the sale of goods, and relates to a situation where this case refers to the sale of goods and relates to a situation where a customer bought a bottle of drink. A customer bought a bottle of drink with a decomposing slug. With a decomposing slug. With a decomposing slug at the bottom. With a decomposing slug at the bottom. Full stop. It established the principles of duty of care. 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 Skip around and say, for a third party to succeed, for a third party to succeed, for a third party to succeed, for a third party to succeed. It's like the points we highlighted for a client to succeed. Again, here for a third party to succeed, must be able to indicate that the auditor was negligent. The auditor, or else the client, the third party, suffered loss. The loss can be quantified in monetary terms. Somebody is saying the what? The auditor owed them a duty of care. Actually, that should be the very first point. That's number one, the auditor owed them a duty of care. Number two, the duty of care was breached. As a result, they suffered loss. The loss is quantifiable into monetary terms. The auditor knew the intended use of the report. The auditor never introduced a disclaimer. The auditor never introduced a disclaimer. It is a very, very, very important point for us to indicate. And of course, the loss suffered can be directly attributed to the negligently prepared report. Let's list those points down. Number one, Roman number one. The auditor owed the third party. The auditor owed the third party a duty of care. The auditor owed the third party a duty of care. Auditor owed the third party a duty of care. Owed the third party a duty of care. Roman number next. The auditor must have been proved to be negligent. The auditor must have been proved. The auditor must have been proved to be negligent. The auditor must have been proved to be negligent. The auditor must have been proved to be negligent, i.e., has breached the duty of care. We are saying the auditor must have been proved to be negligent, i.e., has breached the duty of care, has breached the duty of care. Number three, out of such negligence, the third party suffered loss. Out of such negligence, the third party suffered loss. Out of such negligence, the third party suffered loss. Number next, the loss is quantifiable. The loss is quantifiable into monetary terms. The loss is quantifiable into monetary terms. The loss is quantifiable into monetary terms. Next, the loss suffered can be directly attributed. The loss suffered can be directly attributed. The loss suffered can be directly attributed to the negligently prepared report. The loss suffered can be directly attributed to the negligently prepared report. The loss suffered can be directly attributed to the negligently prepared report. Next. The auditor issuing the report. The auditor issuing the report knew the purpose. The auditor issuing the report knew the purpose for which it was being prepared. The auditor issuing the report knew the purpose for which it was being prepared. The auditor issuing the report knew the purpose for which it was being prepared, knew the purpose for which it was being prepared. And lastly, the auditor did not place a disclaimer. The auditor did not place a disclaimer. The auditor did not place a disclaimer in the report. 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 In the report. All right. So you have to get right to those common law cases, because an examiner can ask you, citing relevant common law cases, so there'll be no option. There's a time that was question number 1. There's a time that question was number 1. I need to be coming with my past papers. So zingine ni za kitambo sana. Andy?
For a third party to succeed.
Yes.
The statement is empty.
Yes. For a third party to succeed, is it full colon or semicolon? Colon, he must be able to prove
That
the something. All right. Let me see what we'll add there, so that there's like a statement that is left hanging somewhere. Yes. English is not easy. English is not easy. So I just want us to highlight a few questions. Just a few, one or two. Yes, you can have these. I've even seen the question I was asking before. So down there, you can have November 2016. November 2016, question number, November 2016, question number 5. November 2016, question number 5. November 2016, question number 5. It read, you are the partner responsible for providing direction to major junior members of the audit department of your firm on technical matters. Several recent recruits have asked for guidance in the area of auditors' liability. They are keen to understand how an audit firm can reduce its exposure to claims of negligence. They have also heard that in some countries, it is possible to restrict liability by making a liability limitation agreement with an audit client. Required A, discuss the civil liabilities of an auditor under common law. 12 marks. Discuss the civil liabilities of an auditor under common law. 12 marks. What I'm sure of is you can't score the 12 marks without a common law case. What I'm sure of, you can't score the full marks if you're just doing English without a common law case. Show the examiner you understand this topic. Highlight head rebellion, at least, if you can't get all those cases, don't afford to miss head rebellion. Head rebellion versus Helen Partners. The two bankers, the SE Power, letter of reference, don't forget that one. Yes. Even after the class, make sure at least to get the head rebellion. The others can come later. Head rebellion is a very serious case when it comes to common law and auditors' liability. Yes. 12 marks. Then part B, which I had answered here, I had looked for it and it was missing. Assess the potential implications to the audit profession of audit firms that sign a liability limitation agreement with their audit clients. This is the story. This is the story. I need to look for the fourth point. We should have at least 4. Yeah, you are also my learned friends. You can try to look for the 4th. I'll also try to look for it. Yes. You see, that's the question. I was sure it was question number 5 somewhere. Yes. So common law cases, we don't have an option. We don't have an option. Start with the head rebellion, then the others will fall. The others will fall. All right. The last subtopic to end up on auditors' liability. Ways of minimizing, subtopic, ways of minimizing auditors' liability. 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 It is somewhere in June 2013. June 2013. June 2013. Question 5B. June 2013. Question 5B. You see, the same question I've answered there was tested in May 2017. Again, question number 5C. They like it when it is the last. Yes, but they have rephrased it. Discuss in each case 4 arguments for and against changing the registration to allow auditors to agree on a contractual cap on liability in respect to the statutory audit. Again, 8 marks. Contractual cap. You are liable to this extent. Beyond that, you are not. Yes, you know the capitation thing. Yes, the same question. Yes, same question. The same question. All right. We can answer that. So about that subtopic that you've already indicated, of course, we need to ensure that we introduce a disclaimer statement. We avoid being negligent. You can even withdraw from a engagements where we realize that liabilities are likely to arise, ensure compliance to all the professional pronouncements, avoid being negligent, compliant to quality standards. We'll be discussing them under ISA 220 or ISQC number 1 or ISQC number 1. Excellent. Number 1. Number 1. The auditor should ensure compliance. The auditor should ensure compliance. The auditor should ensure compliance with auditing standards, ensure compliance with auditing standards and guidelines, ensure compliance with auditing standards and guidelines, including Companies Act. The auditor should ensure compliance with auditing standards and guidelines, including Companies Act. Compliance with auditing standards and guidelines, including Companies Act. It makes audit exercise defensible. You defend yourself with ease. You're asked, why didn't you detect this, or why didn't you do this? Then you quote an ISA. If there was total compliance to ISA and other pronouncements, as an auditor, it becomes very easy. Now, trouble sets in if you departed from the professional pronouncements. Next, the auditor should place a disclaimer. The auditor should place a disclaimer. The auditor should place a disclaimer in the auditor's report. The auditor should place a disclaimer in the auditor's report and in the engagement letter. The auditor should place a disclaimer in the auditor's report and in the engagement letter, in the auditor's report and in the engagement letter, to ensure that it is not used, for other decision making, to ensure that it is not used for other decision making without his consent, to ensure that it is not used for other decision making without his consent. We captured this when you're discussing ISA 810, PFI, when you're discussing the elements of the PFI report, that we have to capture the intended use of the PFI. Should not be used for any other use. We said that anyone who uses it and they were not intended users, they're doing so at their own peril. Ukaniambia inaitwa vorent non-fit injuria, vorent non-fit injuria, which translates to voluntary assumption of risk. Next, avoid being negligent. Avoid being negligent. Avoid being negligent through quality control reviews. 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 Through quality control reviews. Next, withdraw from assignments. Withdraw from assignments. Withdraw from assignments where the scope is limited. Withdraw from assignments where the scope is limited or criminal liability is likely to arise. Withdraw from assignments where the scope is limited or criminal liability is likely to arise. Withdraw from assignments where the scope is limited or criminal liability is likely to arise. Yes, on Monday, I withdrew from an assignment. Yes, I was auditing a circle somewhere in Kikuyu, and I realized all may not go well. All may not. I've audited them for the last 3 years. Actually, even before they transited to a circle, they were a self-help group. Still they audit. But they're not able to maintain proper books. You give your management letter, you advise, but it's because they have a very high turnover rate of their accounts clerk. So before you get used to the system, somebody else comes in. So last year, I even used the manual books to prepare the audited accounts. The systems are incorrect. So at some point, I allowed them to use the auditor's journal record to correct they didn't. So auditing a circle is sensitive because you're dealing with members' money. Pesa ya watu. I had a client in Nyahururu. We used even to go with policemen for AGMs, for our security. Members' money is very sensitive. So they used to pay well, but yes, the way things are going, I find myself in trouble. So you can withdraw from an assignment. You must not audit a client. If you realize that liabilities are likely to arise, you better disengage from a client. Excellent. Number next, screening of potential clients. Screening of potential clients. Screening of potential clients before accepting the engagement. Screening of potential clients before accepting the engagement. Screening of potential clients before accepting the engagement. Before accepting the engagement. Very important. Next point. Describe clearly in the report. Describe clearly in the report. Describe clearly in the report the precise work undertaken. Describe clearly in the report the precise work undertaken. Describe clearly in the report the precise work undertaken, comma, work not undertaken, work not undertaken, work not undertaken, and any limitation in your work. Describe clearly in the report the precise work undertaken, comma, work not undertaken, and any limitation in your work. Muhimu sana. Sema what you've done and what you've not done. What do we mean by that? We wrote these when you're discussing assurance engagements. We wrote this when you're discussing assurance engagements. When we talked of no assurance, about no assurance, then we said the wordings we read, we have not reviewed, stroke examined the company's financial information. We are saying what we never did. We want to be very clear. We have not reviewed, stroke examined the company's financial information, and accordingly do not express our opinion on them. So nobody can come in and say, we relied on your report. This is not an audited report. We never audited, we never reviewed. And when we are discussing the PFI under the opinions, the last statement we said that when the examination is affected by conditions that prevent application of one or more procedures considered necessary in the circumstances, the auditor should withdraw from the engagement or disclaim the opinion and describe scope limitation in the report to the PFI. Scope limitation, the report in the PFI. Because some limitations on scope is when we are not able to gather all the evidence that you expected. So we are saying describe clearly in the report the precise work undertaken, work not undertaken, and any limitation in your work. Next. We are doing point number? 7. Point number 7. Organize for seminars. Organize for seminars. Organize for seminars, comma, workshops and trainings. Organize for seminars, comma, workshops and trainings for the staff members. Workshops and trainings for the staff members. Workshops and trainings for the staff members. We just want to ensure that our staff, our audit staff are equipped with the relevant skills necessary for pass of audit, so that they avoid being negligent and such. Last point, number 8. The auditor should include in the engagement letter the auditor should include in the engagement letter, the auditor should include in the engagement letter, the auditor should include in the engagement letter, the purpose of the report, include in the engagement letter, the purpose of the report, and that the client should not use it for other purposes, and that the client should not use it for other purposes, and that the client should not use it for other purposes, and that the client should not use it for other purposes, should not use it for other purposes. Just a second, just a second. Sorry, I didn't have the slightest idea what was the time. So I thought I'm going for a break, then I come for like an hour, then we go. Eh? Wah, wah, wah. So you can assess what I have inside, the much I want us to cover per session. But not from Saturday. Saturday there's no writing of notes. You'll be listening to what I'll be saying, but I'll be summarizing here. Then you'll already have the notes. I'm sending them tonight. What we'll be discussing on Saturday, I'm sending them tonight. I've already sent into my email account. So just downloading and sending you so that you prepare yourself. On Saturday, I take you through, we check through the past paper questions, and that will be done. Yes, so we'll be branding that. If there are some topics like this one, I must have dictated because it's a bit sensitive. I suspect it will be tested. So if come, I dictate this. That. Your Gmail, eh? Yes, you can forward me my number. Yes, if you have a Gmail, I can always share. I'll be sharing in the WhatsApp group, eh? But if somebody wishes I do in the email, I can always. The whole notes, all the notes. Actually, I've already shared a substantial portion of the notes. Eh? Yes, I've already shared in WhatsApp. To confirm an M-Pesa will do. Clement. Yes. So I shared in WhatsApp. If you've not seen them, I'll reshare again. Join later. I'll reshare again. I will reshare again. I'll reshare again. And this is, let me show our online family. These are past papers organized by one of our friends. Yes. See how well they are organized. Advanced auditing and assurance, other subjects, foro, leadership and management. Yes, leadership and management. Yes. That's how we are organized from this end. Yes. Excellent work. Excellent work. Let's say the grace. Let's say the grace. Let's say the grace. And now may the grace of our Lord Jesus Christ and the love of God and the fellowship of the Holy Spirit be with us now and forevermore. Amen. Wishing you a blessed evening, be safe, blessed month, and all the very best in success. See you Saturday. See you Saturday.